All right, let's get right into it. If you've spent even a little time staring at trading charts, you've definitely seen the classic M and W patterns. They look so simple, don't they? A double top, a double bottom. But here's the thing. There's a hidden trap inside these patterns that almost nobody talks about. And it can literally be the one thing that separates a great trade from another frustrating loss. We're going to pull back the curtain on that secret right now.
So take a look at these two M patterns. I mean, they look practically identical, right? But here's the catch. One of them is a really high probability signal, and the other one, it's a total trap, designed specifically to fool traders and take their money. So which one is lying to you? Most people get this wrong, and that's exactly what we're going to break down.
You know, if you've ever tried to trade one of these, you've probably felt this exact pain. You see the M's start to form, you go short, and then boom, the price just blasts right past that previous high, stops you out, only to reverse and go in your direction moments later. It honestly feels like the market is personally hunting for your stop loss, doesn't it? So why does this keep happening?
Well, here's the big reveal. The secret isn't actually in the shape of the M or the W. Not really. It's all about something invisible that happens while the pattern is forming. We have to stop just looking at the lines on the chart and start understanding the action that just took place.
And that action, that secret ingredient that completely separates the pros from everyone else, is one simple word: liquidity. Now, I know it's a term that gets thrown around a lot, but trust me, when you truly get what it means, it's going to change how you see these patterns forever.
So what in the world is liquidity? Let's make it super simple. Just think of it as the market's fuel. See, at any important high or low on a chart, there's this huge pool of orders just sitting there. We're talking about people's stop losses and all the traders waiting to jump in on a breakout. For the market to make a really big, powerful move, it needs to grab that fuel. And this, right here, is the heart of it all. The one huge difference between a pattern that works and one that's a trap is this. One of them has successfully taken the liquidity. That's not just some minor detail. That is the entire secret.
You know, a great way to think about it is like a slingshot. To launch a rock forward, you have to pull it backwards first, right? You build up that tension. Well, the market does the exact same thing. It will push just a little bit past a previous high or low just to grab all those orders, all that fuel, and then it uses that energy to launch an incredibly powerful move in the total opposite direction.
Okay, so theory is one thing, but let's actually see what this looks like on a chart. We're going to put the trap, that false breakout, right next to the true signal so you can train your eyes to spot the difference when it's happening live.
Okay, look closely here. This is the trap. See how that second peak pushes just a tiny bit above the first one? That's the slingshot pulling back. It fools all the breakout traders into buying, and at the same time, it triggers all the stop losses from people who shorted too early. The market grabs that fuel, and once the tank is full, the breakout fails and the price reverses hard. This is the pattern that has taken the liquidity.
And now, look at the difference. On this one, the second high doesn't break the first. See that? No breakout traders were tempted to jump in. Fewer stop losses were hit. This pattern never did that critical liquidity grab. It didn't load the slingshot. Now, a reversal might still happen, sure, but it usually doesn't have that same explosive power as the trap pattern.
So this is all great, but how do you actually use this in your trading, like right now? Well, you need a simple, repeatable checklist. So let's build one. A quick 3-step process you can use every single time to spot these high probability setups.
Okay, here it is. Step 1. Just find a clear M or W pattern that's forming. Simple enough. Step 2, and this is the most important part, look for that liquidity grab. Ask yourself, did the second top just poke above the first one? Did it dip just below the first bottom? And then step 3, and this one requires patience, you have to wait for the failed breakout. You need to see the price come back inside the previous range. That move back is your confirmation that the trap has been set and is ready to spring.
Now, knowing the pattern is one thing, but let's be real. Managing your own emotions is at least half the battle. This whole liquidity grab setup is practically designed to trigger emotional reactions. So let's talk about how to keep a cool head.
These are the big 3 emotional mistakes you've got to avoid. First, FOMO, that fear of missing out. It's that feeling that makes you want to buy that tiny little breakout right before it reverses on you. Second, revenge trading. If you get caught in the trap, don't just jump right back in trying to make your money back. And third, the biggest killer of them all, impatience. You absolutely must wait for step 3 of our checklist. Wait for the price to come back into the range. Don't try to guess it. Wait for it to prove it to you.
So there you have it. We've pulled back the curtain on the M and W patterns. You can see now that it's not just a simple shape on a chart, it's a story about a fight for liquidity. You now know exactly how to tell the difference between a trap and a real signal. So the only question left is, now that you can spot the trap, how are you going to trade differently tomorrow?